Hi, everybody.
Hello.
Hello.
It is good to see you all. I'm waiting for 3 o'clock, and I saw it looked like Deborah had started to join, but now she's not here. So let's just wait a moment and give her a chance to sign in. All right. There's Deborah.
Hi there.
Hi.
Hi.
Okay, well, glad you're here. It's 3 o'clock. So I'm going to call to order our last Zoom meeting of the Finance Committee before we start to meet again in person. It has been a long time coming. And I'll call the roll of the committee members. Barbara McKenzie.
I'm here.
Thank you, Barbara. Dave Cahill.
Here.
Hi, Dave. Deborah Doyle.
Here.
Okay, thank you. And pursuant to California Government Code Section 54953, all votes during this teleconferenced meeting shall be taken by roll call. Next item is public appearances. Do we have any members of the public who are attending and wish to address the committee regarding matters not on the agenda?
I do not see any members of the public.
Thanks, Lisa. Did we get any written addresses to the committee?
We did not receive any written comments.
Okay. Well, we have a lot to cover today, so I'm going to move us right ahead into our first discussion item, pension cost strategies. And this, as you know, is a topic that we've broached before. Myrna has done all the heavy lifting on this, and in just a moment, I'm going to turn the presentation over to her. And I know we have some guests, and Myrna, I'll ask you to introduce them to the committee. I just wanted to say a couple of things before we dive into this topic. I'm going to ask our committee to try to engage with this topic in two ways simultaneously. First, obviously, I want to be sure that everybody on our committee feels really comfortable and confident in their understanding of the issues and of the options that are available. Second of all, I'm going to ask you to be thinking about what we might also need to do to help other members of the commission who have not dealt with the topic as frequently as we have and perhaps are not quite as familiar with it, so that they also can get to that point. Because I'm hopeful that we're going to be making some decisions in this area, and I want to bring everybody along to that point. So please keep those two perspectives in mind. And Myrna, I'm going to turn this over to you. And thank you in advance for everything you've done on this very complex topic. Yeah, you're on mute, Myrna.
No wonder anyone was responding. So do you see my notes or not?
No,
No.
this is good. We're
Perfect.
good now.
Okay, great. So I'm really excited to be at this point today, and commissioners, as planned in February, you were to have an overview of the library pension costs. And I worked with CalPERS representatives to provide examples of tools that are used to manage pension costs. Corey Yang, our CalPERS actuary, and Kurt Snyder helped put these scenarios together. And today we have Corey with us to answer any questions, and Karen Lookingbill, who will be presenting on the 115 Trust. And thank you, a special thanks to Andy for your feedback in preparing this this presentation and for you all.
Hey, Myrna, I think Kurt is also in our meeting.
Oh, great. Thank you, Kurt, for being here as well. So in speaking with Andy, he wanted to provide a framework of what we will be covering today. And this was your cue, Andy.
Okay, thank you. So I'm just gonna follow Stephen Covey's guidance to begin with the end in mind. And so I wanted to just offer a short overview, and please, those of you who are pension professionals like Corey and Kurt and Karen, please pardon me if I don't depict this with 100% detailed accuracy. But as Myrna will be explaining to you, every year we have two components of our pension payments. And one component is a pay-as-you-go part, which is required based on actual salaries. And that's just going to continue to increase as our staff hopefully continues to grow and as we're able to pay our staff at a higher rate. In addition, we currently are dealing with a gap, which is referred to in pension language as an unfunded liability. And in broad terms, this is the difference between the total value of the assets in our pension plan and the actuarial projection of what we're going to actually have to pay out to current and former employees. As you can imagine, this is a very complex calculation. There's always some variability in it. The value of our assets fluctuates daily with the investments in markets around the world. Similarly, the claims on the plan will vary depending on when our employees choose to retire or how long they live after they retire. But in any case, we have an unfunded liability that we have to pay down over time. You can think of it a little bit like a mortgage, but that's not a precise analogy, because with a mortgage, you know the exact amount that you owe, and as you make additional payments, the balance decreases. With the pension, it fluctuates based on investments. As you'll see, and Myrna's going to go into this in detail, really we have three ways that we can deal with this unfunded liability. One, and this is the column on the left, is just to continue what's called the pay-as-you-go option. And that means that we continue to make the current payments that are required. And in addition, CalPERS prescribes that we need to make a certain additional payment every year to start to reduce that unfunded liability. A big part of that payment is interest, in the same way that it would be on a mortgage. And a small part of it helps to gradually reduce the amount of the unfunded liability. CalPERS has become more aggressive in recent years with this, and so we are making progress. And as you'll see, we're not in a terrible condition in terms of our unfunded liability, but it's still substantial. A second option is to make additional discretionary payments, and that's what the ADP refers to. And you can think about this again, it's an analogy, it's not perfect, but if you were to make additional payments on your mortgage, so if you increase the amount that you paid every month, or perhaps made 26 payments in a year instead of 24, your mortgage would be paid down more quickly, which means that over time you would pay less interest as you started to pay off your balance. And that's the big benefit of the ADP option. A third option, either alone or in conjunction with additional discretionary payments, is to set up what's called a 115 trust. This is what we have for OPEB. And it sets additional monies aside, which we as a commission can use at our discretion, of course, with the guidance of our CFO, as needed to adjust to changing conditions. Myrna and I have talked about this. We believe the best option for the library is going to be the combination of additional discretionary payments and the Section 115 trust. But we're not the ones making the decision. So that's all I'm going to say by way of overview. Myrna, I'm going to turn this back over to you. And do you want people to ask questions as you go through it, or do you want them to hold questions until you call for them?
I think when we get to the scenarios, and since we have Corey and Kurt here, that we can ask questions as when we're presenting those.
Okay. Okay. Thank you very much. Please go ahead.
Okay. So thank you, Andy. And I know that this is something that you've been wanting on the agenda. And I wanted to start with the overview of pension costs. What does the library pay in terms of pension costs? And why do we have that? Our pension costs are driven by our defined benefit pension plan. And a defined benefit pension plan is when an employee retires and they receive a guaranteed monthly payments based on a formula that incorporates the number of years of service and earnings. And the longer the employment and higher their earnings, the higher their retirement payout. And the total minimum required employer contribution is the sum of two components, the normal costs and the unfunded accrued liability. The library has been making the minimum required contributions, and this is known as the pay-as-you-go method. Contributions are based on actuarial reports, CalPERS forecast, and determines what that rate of return it expects from the investments that we've made. And this is called the discount rate. At this time, CalPERS has determined a discount rate of 6.8%, and this rate is evaluated every 4 years. So what is the normal cost? The normal cost is the pension contribution for the active employees that is paid by the employer and the employee based on a shared agreement. And it's based on a percentage of payroll, and it's calculated as we pay payroll, or we pay every 2 weeks when payroll is administered. Unfunded liability is the difference between the expected future benefits and the value of the assets in the pension fund. Each year, we are required to pay interest on this amount and make a payment to reduce the difference, the principal. This is a summary of the library's pension costs for the current fiscal year. The employer normal cost rate is 10.51% of payroll, and it's estimated at 1.8 based on budget. And the unfunded accrued liability balance is $15 million. And the minimum payment for that is about $1.3 million. So in total, the estimated pension cost for this fiscal year is $3.1 million. The Finance Committee has been discussing the strategies to address the unfunded accrued liability. However, there are also strategies to address the normal costs. I will go into both of these, but I will start with addressing strategies for the unfunded accrued liability. And an important measure of health of a pension is its funding status. What percentage of the expected benefits are funded? This is a snapshot from the CalPERS website of the entire CalPERS portfolio. And CalPERS in fiscal year 2021 had a funding status of 81.22%. And the last year is 72%. I'd like to make an important note that as a general benchmark, according to CalPERS, a healthy pension is funded between a range of 80 and 90%. This is a snapshot of recent history for the library. We've ranged from 79% to 93%, and most currently we're estimated at being 82% funded. So therefore, we have been in a healthy range. The fund status is an assets to liability ratio. Essentially, accrued benefit liability is greater than the assets. When accrued benefits liability is greater than the assets, the funded status is less than 100%. And here are 3 fiscal years and of the library funded status. The red is the unfunded status, and the green is the funded status. So red is represents our accrued unfunded liability.
And Myrna, I'm going to jump in for just a second to remind the committee of something that we've looked at. You can see here that for the year ending June 30th, 2021, our funded status took a significant leap in the positive direction. And that was because of the very strong returns of markets all across the world that year. You can see the net return was 21.3%. Last year, investment markets had a pretty substantial loss, and we're back down into the 80% range. So you can see how much impact a particularly strong or weak year can have. Now, that said, compared to funds as a whole that CalPERS administers, the library is toward the stronger end of that continuum, right? Because for most years, it looked like average funds administered by CalPERS were at around 70%. For the year ending June 30, 2021, they went up to about 80%. So they showed that same 10% increase. Now they're back closer to 70%, and we're closer to 80%. So our variability is similar, but we are in a somewhat stronger position than the average pension fund administered by CalPERS. Thank you.
So again, the point with this slide is that our UAL varies based on market conditions and its natural volatility. And CalPERS does its best to estimate what expected rate of return it can expect from its investments. And as you can see, in the year 2020, the discount rate was 7%, and the net return was 4.7%. So when the net return is less than the discount rate, our UAL really it shows an increase. And like Andy said, in year 2021, we had strong returns, and the discount rate was 7%, and the net return was 21.3%. So this gap of unfunded accrued liability decreased, and our funded status increased to 93%. But as quickly as we made headway to reduce that unfunded accrued liability, the market experienced a great loss, a negative 7.8% in 2022, and the discount rate was 6.8. So again, it increased our UAL and decreased our funded status. And this keeps going. But there are strategies to manage this gap, and that's what we're going to go into. I did want to say that year 22 is this is an estimate based on my discussions with the CalPERS actuaries and with a tool that CalPERS developed for employers called the Outlook. And you enter data points like the loss, the net return loss and the discount rate, and it will closely estimate where our funded status is today. That's how we arrived to 82%. Our official actuarial report will be provided in August of this year. So we'll jump into the scenarios, and the first is how to address our unfunded accrued liability. And we have two scenarios with additional discretionary payments. Our actuaries, Corey and Kurt, developed these scenarios using the following assumptions. Starting on July 1, 2022, CalPERS estimate of annual investment return, or the discount rate, is 6.8%. That is net of investment and administrative expenses. Also, since fiscal year 21-22, the investment return was negative 7.5%. And even though we have not received the official report, this figure has been made public and published by CalPERS. The baseline scenario shows what we're currently paying, and it's our pay-as-you-go methodology, and it does not include any additional discretionary payments. So I will show you scenario 1 with these assumptions in mind. So you can ask questions. Our actuaries, Corey and Kurt, are here to answer questions as we go. In this scenario, we see I'll speak to the baseline scenario. We start with our UAL balance of $15.1 million. And we have, if nothing changes, and we're basing this on the assumptions made, we have a schedule of minimum payments that we're required to make. And after 10 years, we will be 93% funded. Okay, this doesn't predict any major losses or gains here, but if it's consistent according to our assumptions, we will be 93% funded. But we have been talking about possibly making additional discretionary payments to pay down the UAL. And I asked the actuaries to look at a 3-2-1 scenario where we make an initial $3 million payment, then a $2 million payment, and then we drop down to $1 million. So the total additional discretionary payments over 10 years would be $4.3 million, minimum of payments toward our minimum payments is $9 million for a total of $13.4 million. So in the 3-2 scenario, the library makes a total of $4 million additional payments over the next 10 years. Are there any questions at this point?
Not a question. I'm going to jump in with a comment, Myrna.
Okay.
As I kind of mentioned in the intro, CalPERS requires, when we have an unfunded liability, not just that we pay interest on that at a current rate of 6.8%, but that we also make payments to help reduce that liability. And that's what you see in the baseline scenario. that if we take no additional action on our part, this is what CalPERS is going to require us to pay. Now, this is all in addition to the current costs we're paying for our staff who are employed now. Over this 10-year period, we're making additional payments of $14.57 million. And at the end of it, assuming there were no huge swings in investment markets, we will be at about 93% funded. The second scenario gets us to the same goal, right? After 10 years, we're at about 93% funded. But in this case, the total payments that the library needs to make, in addition to the current payments, are $13.4 million. So you can see that over the course of the 10 years, by paying a little more upfront, we're saving the library a total of $1.1 million. Is that clear to everybody? And do you have any questions on that?
Okay, great. So again,
This is a summary of what you just said, yeah.
this slide is, we just went over the key points here when we looked at the chart. And as a result, like Andy said, we're comparing the $14.4 million that we would be making under the baseline scenario versus $13.4 million, and it is a savings of $1.1 million. This is
Barbara,
scenario 2. This is a more aggressive option where, again, you have the baseline scenarios for comparison, but here you will see that the payment plan is more aggressive, where we start with $3 million in the first year, and then year 2 through 8, we maintain a $2 million payment every year. So in addition, so we make the minimum payments of $5.8 million, additional payments of $15.1 million for a total of $21 million over the 10-year period. And this, that's $6 million more than the baseline scenario. So I'd like to stop here and see if anyone has questions on this.
Yeah, Barbara has a question. Please go ahead.
Excuse me, I've been really sick for a couple of weeks. The additional discretionary payments, I guess I'm just starting to sink in here that these are going to be required. Have they been required in the past, or when did these kind of pop up as an additional requirement? We've been doing pay as you go as long as I know.
The pay as you go has two components: the normal costs and a minimum payment toward the UAL. And the baseline scenario that you see here is that minimum payment towards the UAL. So we have not been making additional payments, are not additional payments. These are our required minimum payments.
Yeah, we have been
making those.
Yeah, okay,
Yeah.
that's.
And so
Right.
if I could just, I'm going to make an editorial comment here, and if somebody from CalPERS wants to disagree with me, go ahead. But my, layman's view from the outside is that over the last few years, CalPERS has taken steps to help all of the agencies like ours that have pension funds managed by them to shore up those pension funds. So, for example, one thing has been that they have reduced the discount rate. The discount rate is the estimate of the rate at which investments will increase in value. If our plan is underfunded and we just assume, hey, we're going to make 12% a year, why, in pretty short order, we're going to be looking great, but that's not realistic. And so over the last few years, CalPERS has reduced the discount rate, and now it's at a more realistic 6.8%. The other thing that they've done is to increase the amount of minimum payments that are required to help us bridge the gap. So you can see in the baseline scenario that Myrna outlined here with the help from our CalPERS colleagues, over the course of the next 10 years, we are significantly increasing the funded ratio, even if we do nothing, right? Even if we do only what's required, assuming that markets behave, we'll go from about 83% to about 93%. But to do that, we're going to be paying close to $15 million. So is that clear to everybody? And we don't have an option. This is required.
That's
An
good.
additional discretionary payment would be on top of this.
Yes, and that's the scenario 2 that we're showing here, is that we're making the minimum payment. And as you can see, as we're making additional payments, the additional payments are going towards paying down that principal and the interest, and helps us with the minimum payment side, so that eventually we do end up here in this scenario, aggressively reducing our AUL and having in this scenario up to 100% funded.
Myrna, can you advance to the next slide, please, so we can just summarize this because this is a little more complex scenario. In the first option that we showed, we ended up at the same point, but the library ended up paying less money. In this scenario, we end up at different points, right? With the baseline scenario, we end up at 93% funded, whereas the aggressive ADP scenario brings us close to 100% funded. Now, we pay more money in this scenario, but we reduce the unfunded liability balance by a significantly greater amount. So although it's less apparent in this second scenario, we actually end up saving, looks like an estimate of $2.7 million. Now, personally, I feel like the second scenario is going to be a little harder for people to understand and buy into. And I think we can ask our CalPERS colleagues here, I'm not sure there's a compelling reason for the library to try to get above 93% funded over the next 10 years. So to me, the first scenario, the 3-2-1 scenario, feels like it would be easier to get buy-in from the commission, and the benefits are more easily evident. So I'm going to stop here and just ask Corey and Kurt, do you think that there is a strong case that we should make to the commission that, getting to 93% over the next 10 years is not as ambitious a goal as we should have?
So this is a little complicated, and I know Myrna said that 80 to 90% is healthy. As actuaries, we like to say that there's really no single line that defines what's a healthy and unhealthy plan. What there needs to be is a way, a responsible way to get to 100% in a reasonable period of time. So I would say that getting to 93%, you still have, like in that scenario where you only got to 93%, there's still sorry about the blinds behind me. There's still $9 or $10 million in unfunded liability that still needs to be paid. Whereas in the other one where you go to 100%, then you're caught up. The benefits that have been earned, money is set aside, it's earning investment returns, and it's there for retirees. So regardless of where you are at one point in time or where you hope to be at another point in time, you still need a plan to get the whole thing paid off.
Okay. Yeah, that makes
I'd like to say something. It's the what we will see is in full strategies to address the UAL, and that's where the 115 trust comes in. And also, it is the governing board or the commission is the one that establishes what goal you would like, what's your target, what's your goal, what are you comfortable with in terms of having an unfunded liability. From my experience and what you've seen in these slides is that 100% is not permanent. It could be from 1 year, a few months you'll be 100%. The volatility, in the market will change that, and it could change radically, as we could see over the last 3 years. So, from my point of view, we have a lot of competing priorities, and getting to 100% is a moving target. And Kurt, please, jump in if you'd like, but that's what we've seen. And the library has a lot of, like I said, a lot of competing priorities. And I think it is important to pay down substantially the UAL, because it is, we're paying on that UAL 6.8%. That's pretty high. And we're chipping at it a little bit, but it does draw down on the resources of the library. So, I wanted to put that out there. And also, Karen Bill will take a look at the 115 trust. So there is an opportunity that I like you to think about.
Myrna, can I stop you for just a sec before you get to the 115 trust?
No,
Because I do want to point out one other thing about these two different scenarios. You can see here in scenario 1 that it proposes a $3 million payment in fiscal year 22-23 and a $2 million payment in fiscal year 23-24. Could you advance, please, 2 slides to scenario 2? You can see here that it requires a $3 million payment in 22-23 and a $2 million payment in 22-24. It would seem to me that a prudent path would be to plan to make these payments and then to reassess, particularly if we put the sales tax measure up for renewal in 24. We would be in a much better position to reassess how to move forward after that hopefully passes. So that's my only comment.
So what I was getting at and what we stated up front when we started this meeting is that we could have a combined strategy where when the library reaches a certain target, we can also establish a 115 trust that that earns interest, right? So the lower our UAL balance, the opportunity cost is decreased, and we can establish a 115 trust so that we can earn fund, we can make earnings and create some flexibility.
And I would want to just add one more thing to what Andy is saying. So on this page right here, if you look at these scenarios, if you were to follow this baseline scenario and just pay the minimum, those minimum payments, you see they vary every year, and we do evaluation every year. They'll get recalculated. They're not going to be those numbers, right? You don't know what they're going to be. Whereas if you were to choose one of these other scenarios, let's say you did this one, and you say, we want to do 3 million the first year and then 2 million in the next few years, those numbers include the minimum and the ADP. And when we do evaluation and we get different results, you could still do the 2 million that you planned on doing, just a different ADP and a different minimum, but
Right.
It gives you the benefit of contribution stability and knowing, budget certainty that you don't get from doing the what you're calling the pay-as-you-go method.
Yeah,
Yes,
thanks,
and-
Kurt. That's a good point, especially Myrna, as you're working on the 5-year financial projection.
Yes, and the other thing is that you can compare, right, is that further down in the baseline scenario where, we'll be making, in 2029, approximately $1.7 million payment compared to 2 million. And we're getting more bang for our at that stage. So lots to think about, but there's a lot of information here that you guys can digest and continue to look at, and we could, bring these back for discussion.
Okay, thank you. I didn't mean to cut you off, but I wanted to just cover that before we get to the 115. So please
Okay.
go ahead and I'll be quiet.
No, thank you. No, this is all good. I hope that we can have a broad discussion here with all members of the Finance Committee. So the previous slides and a lot of discussion has been around the additional discretionary payments. And this next tool can be used in combination with the ADP or on its own. And this is the 115 trust. The library has experience with a 115 trust that it's set up for OPEB costs. And in general, the library can, in this case, I'm just really briefly, because Karen will go into more detail in terms of how a 115 trust works. But if we initiated a trust with $2 million and then made $1 million between years 2 and 10, we would have contributed $11. There's there's different strategies, and one strategy we could earn 3.5%, and another strategy we could earn up to 4.5%. So in total, we have a cumulative savings with this investment. There are fees associated, but at the end of the 10 years, we would grow our $11 million either to $14.14 million or to $13 million. So with that, here's again, you saw this slide at the beginning. Again, we have our pay-as-you-go method. We can rely on, pretty much it's funded by our operating revenue, and it does go up because, as you saw, as payroll goes up, so does the current our current costs. And we looked at the ADP option, and next we'll look at the 115 trust or the SEPT option. So with that, I'd like to introduce Karen Lookingbill from CalPERS, and she will present. And thank you so much, Karen, for preparing the next presentation. I want to thank Corey and Kurt for your time and creating those great examples for us to digest. And if you still have time to be on this meeting, that would be great if there are any additional questions as we compare these options. Okay, so Karen, you should be able to, I just stopped sharing. You should be able to bring up your presentation.
Sure. Thank you, Mirna. Good afternoon, everyone. A lot of the slides are very similar to what has been presented, so I will try to be brief and concise. I would like to share more information about the SEPT, the California Employers Pension Pre-Funding Trust. It's a Section 115 trust, so it is an irrevocable trust dedicated for you to pre-fund future pension payments. And as Mirna has mentioned earlier, pension payments are normal cost and UAL payments. But very briefly, I wanted to share that at CalPERS, there are two Section 115 investment trust funds. On the left side is the OPEB trust. It's called the SERPT. You have joined this trust fund years ago, and you have been enjoying significant investment earnings. Currently, we have 600 agencies in this trust, and it was established in 2007. And then on the right side would be the trust that we are discussing now. It is something for the library to evaluate. It was established in 2019, and we have about 81 employer participants in the SEP, the Pension Pre-Funding Trust. In terms of cost considerations, please note that the normal cost and usually the UAL, the 1-year amortization of the UAL, is something that each agency would have to budget for each year. The normal cost is the forever cost or the perpetual fee. It's the percentage of payroll. It's not going to go away. The UAL, based on your payment schedule, hopefully you will reach your desired funding level, 100% funded at a certain point. But what has been mentioned earlier, it could reoccur if the plan is negative. If the market underperformed, more than likely there might be some UAL in the future that the library has to pay. So the outlook mostly for municipalities or public agencies would be that given these two cost components, there's a likely increase of the required pension payments for the next 5 to 15 years. The cost could be fluctuating or volatile. And the question always is there something that we can do today so that we can prepare ourselves for these increasing costs? And the answer is yes. And we've been discussing it already. I think doing an ADP, additional discretionary payment, with a combination of a Section 115 trust are very prudent, proactive strategies for the library. And this is your pension plan summary. Mirna has shared this earlier, so I do not have to discuss this anymore. These are all estimates based on the recent valuation reports we have. So the main tools for any public agency to consider in terms of managing pension costs is the combination of the additional discretionary payment and the 115 trust. The ADP really is a very strong, powerful tool so that you can reduce your unfunded liability for pension. It's a great catch-up strategy. Now, the 115 trust is actually your keep-up strategy. It gives you an opportunity to save and finance for the future so that your cash flow will be smoother or more stabilized. It does smooth out the possible future contribution streams for your agency. So why pre-fund pension contributions? Really, most agencies would ask us, can I just do one or the other? Can I just do the ADP and not the 115 trust? Or can I just do the 115 trust and not the ADP? We always say that, please, if you can, do both because they have its own benefits. But agencies that decide to pre-fund contributions do it because they want to have an opportunity to grow assets for any future pension contribution, because these are required pension payments anyway. So if you can be proactive and get ahead of it, we can possibly make it more affordable for you. So it could be pre-funding normal costs, pre-funding UAL, or even future ADPs. It also gives you the opportunity to earn higher than LAIF, county treasury, or money market accounts. So over the long term, more than likely, there's a big probability that your assets here will earn more than what you're getting with your low yielding investment instruments. It allows you to stabilize future budget, and the SEP pension pre-funding trust will actually create a pension reserve, a rainy day fund specific for your pension obligation. And one advantage, of course, for the 115 trust is it does preserve liquidity. It allows you to ask for reimbursement, liquidate a portion of your assets in this trust to reimburse yourself for all of the CalPERS pension payments you've sent for that particular year. I wanted to quickly just show this illustration, but this shows that if we assume a perfect investment role, and I know it doesn't happen, but a hypothetical scenario that should you participate in one of the strategies of the SEPT, it continues to earn each year 4.5% for you, then over the long term, it will produce significant investment earnings. So potentially, if you look at the future value of $1, in 10 years, that dollar could be $1.55, meaning the SEP could potentially earn you 55 cents out of that dollar. Now, I know I'm only talking about $1 or 55 cents here, but once we include several zeros to this amount, then it becomes really powerful, becomes significant. In fact, the last row is something that we calculated in reverse. So it's a hypothetical scenario if you wanted to ask, what if in 10 years I would like to generate $1 million? How would I invest it if it's in the SEP? So here, if you look at this table, if you have about $644,000 today, and assuming that again that the SEP performs as expected 4.5% or as planned, we could potentially generate you 356K of investment earnings, giving you an asset balance of $1 million in 10 years. So where does the investment option for the SEP would play, given that you're already using existing tools now? We understand that most of your reserves or your general fund are kept either in a LAIF account, a money market, or a county treasury. We are huge fans of those because those are low risk investment instruments. And the SEP by design is a conservative investment portfolio, but it is hopefully meant to outperform those low yielding investment instruments. So that's why you can see that we feel that might be a sweet spot for a lot of employers or agencies. Very briefly, we wanted to share with you the investment returns. I know that he's a very busy slide, but the top portion would be the investment returns of your existing OPEB trust fund. And then the bottom portion would be the investment returns of the SEP, the pension pre-funding trust. You can always compare our returns versus the benchmarks. And the main key idea here is that our performance, CalPERS investment office, whenever they manage these funds, that the investment performance or returns are very similar to the benchmarks, which is what we want to emulate or what we want to mimic. Should you decide to set up a SEP account, it's very similar to how you manage your OPEB trust account. You have full control of your participation. You are in the driver's seat. You have a choice where to invest or which investment portfolio to participate in. And then the contributions are purely voluntary. So you can go to the governing body, request to set up the account, and then make another decision in the future if ever you want to make contributions or even ask for disbursements. Now, the next several slides would be plan experience. We wanted to show you how more than 80 agencies are participating in the program and for your consideration. Majority of the agencies in the trust, in the SEP, are using it so that they can truly grow pension assets so that to help pay for these CalPERS pension payments. So it could be something similar for the library. You can use it just for normal cost pre-funding. Roughly your normal cost is about $1.5 million. You can use the ADP as your UAL strategy, and then the SEP, and for normal cost pre-funding, you can use the SEP. What is important is if you allow time, be a friend, to be able to invest for a medium or a longer term so that we can generate significant investment earnings for you. Mirna has already shared this hypothetical SEP investment performance, and we can clearly see here that over a decade of investment time horizon, significant investment earnings could be experienced for the library. And another view that you would like for you to consider would be in terms of normal cost pre-funding. So these are all estimated potential normal cost payments for the library for the next 11 years. Some agencies prefer to do a target year pre-funding because it makes them more realize what the savings for the agency. So in this particular hypothetical example, if we're just looking at fiscal year 29-30, roughly, the library could be paying a normal cost of about $1.8 million. But if we want to pre-fund today, and that's the question would be, how much can we send in the SEP? And the answer would be 1.26 million. If you have $1.26 million today, and this, again, assuming that the program continues to generate 4.5% interest year on year for the agency, then that means that roughly 500K of investment earnings will be realized in that 8-year time frame. So when this fiscal year rolls in, more than likely you can tap into your SEPT account to pay for that normal cost for the year. Others also use the SEP as a rainy day pension cost fund. And in terms of how much they can put, some would just put a small portion just to get started. So 3 months of pension cost, but it does give them, the security that we have set aside a little bit of money in case there are spikes or increase in required pension payments in the future. We can rely on the SEP to help supplement our budget for the year. And these are some of the employers and how they drive their own funding strategy, because clearly this is your decision. Some are fortunate to have some pension reserves. So when they join the SEP, they would put in their pension reserves. Others might want to do an initial contribution, but their future contributions are undetermined. While others would have a more strong or prudent approach. They want to do additional discretionary payments as well as do the 115 trust. So they would do that hybrid approach. While other agencies join the trust and they set up the account, but they do not actually have any idea yet in terms of when can they fund their SEP account. So we charge a very minimal fee rate of 25 basis points. So it's 0.25% of your assets. So here in this illustration, what we're saying here is if you ask us to manage $1 million, roughly the annual cost would be $2,500. So why work with CalPERS? What are the advantages of the SEP program? It is very similar to how we support you with the SEP, with the OPEB trust. CalPERS as the largest pension fund, as well as the largest 115 trust provider, we have the investment policy and management expertise. We benefit from the economies of scale, and that's the reason why we can also offer the lowest participation fee rate. We're very committed in supporting our customers. We're a small team of 13 people. So whether it is your OPEB trust or your pension pre-funding trust, we're always available to you. It's easy to join this program. I will definitely work with you in the entire process. And CalPERS being a public agency, highly scrutinized, we need to make sure that we're always in compliance with the government accounting standards. So in terms of evaluating your options, I know that we have a lot of options here. We've talked about doing pay-as-you-go, doing the SEP option. But the best really that we're thinking of is to do a hybrid or a combination of both. I'm sorry, I apologize.
I see we have a question
sure.
from Dave
Yes.
Cahill, please.
Yeah, if you could go back to page 18
Sure.
for a moment.
Here.
Yes, the first bracket. These are advantages.
Mhm.
No socially conscious divestment. First, what is socially conscious divestment, and why is not having it an advantage?
Thank you for answering that. So the actual CalPERS pension fund, I believe in 2016, have officially divested in certain asset classes or in guns, in tobacco, etc. But for the SERPT and the SEPT, it is we are not doing that. And the reason being is that we work with SSGA, State Street Global Advisors. They are our external third-party investment manager, and they manage the entire funds for us. So it's a $16 billion fund that each employer buys units or shares of the fund. So if it is a fund with like 8,000 maybe holdings, it's not something that we can just divest. If ever this would become an option, this will definitely shoot up the fees of the SERPT and SEPT. That's why it is not a direction that the Section 115 Trust program is going to.
Okay, so if I could just follow up a little bit.
Sure.
This means that this particular trust would be participating in investments in alcohol, tobacco, and fossil fuel companies?
I would have to confirm with you exactly what are the current holdings, David. So what I can do is I can look at exactly the holdings, especially in all of the asset classes.
Okay, thanks.
Mhm. So if there are any more questions, I apologize. So I'm on this slide. So in terms of what are the next steps, evaluating your options is a similar slide that Mirna has shared earlier. We can continue doing pay-as-you-go, but we know that it is the most expensive option. There's always budget dependence. It is a reactive approach. Or you can start looking at what are the proactive approaches, which we have already discussed this afternoon. A hybrid approach of doing an ADP or a 115 gives you an option to keep up as well as catch up with your pension obligations. Thank you.
Karen, thank you very much.
Mhm.
I have a couple of questions for you, if I may, please. One has to do with in investment return. It looks like you have two different options. They're both, I would say, fairly conservative.
Yes.
Designed to be relatively low risk and less volatile than the normal CalPERS
Pension fund, correct.
Is that correct?
You are correct.
Okay. And now, not meaning to give you a hard time, but following up on Dave's question, if, and I'm not saying that we would, but if we were to determine that we only wanted to do socially conscious investing, the benefits of the 115 trust would still apply, but we might not end up doing that with you.
Absolutely.
Yeah.
Yes.
Okay.
And just to be very transparent, so CalPERS is not the only 115 trust provider out there, and there are others that allow you to truly pick and choose your asset classes.
That's great. Thank you. Thank you very much for your
You're welcome.
presentation. Barbara, you have a question.
Oh, sorry.
Just a quick question, just to verify what you just said in terms of the two investment options for the trust, they're both more conservative than overall CalPERS investment. Is that what you said?
Correct. It
Okay.
is designed that way.
Okay, thank you.
Thank you.
Yeah. Any other questions for Karen or for Kurt or Corey while they're with us? Well, listen, I want to thank all of you for joining us today, and even more for the work you've done with Mirna in preparing this for us. I imagine that we may be getting back to you in the future, either with additional questions or because we want to move forward with one of the options that you've proposed. So let me thank you in advance for your help. And since it's 4 o'clock and we still have some business to conduct, I'm going to invite you to kind of get back to your busy days. And I know Mirna will be in touch as needed.
Thank you. Appreciate all your work.
Thank you.
Thank you. Enjoy the rest of the day.
Thank you all. Before we go on to the next agenda item, I'd just like to hear individually from each member of the committee with just your high-level reaction, initial impressions, and kind of what you see you would want to have next. So, Dave, I'm going to start with you, if I may. Give us your high-level reaction to what we saw today, both with regard to the additional discretionary payments and the potential benefits of a separate 115 trust.
Yeah, if we go the 115 route, I think we need a trustee other than CalPERS because of their investment strategy. I'm not willing to essentially take in a higher investment return with helping fund the current climate problems around the world. So I would not want them as trustee. I will rely on Mirna's guidance as to whether or not we want a 115 plan and other possible trustees. I also our revenue has been remarkably stable over the past several years, despite the possible collapses during the pandemic, which didn't happen. So I guess that's something fairly positive. I'm not sure we need that much of a cushion for downturns because, I mean, we're not even having a recession right now, at least not with regard to sales and property tax revenues. So anyway, that's my my thing. I'm going to rely on Myrna to make a recommendation here. Okay.
I no, appreciate that. And let me just make one comment. And I thought you were going to land where you did in terms of the trustee, but you've also, you know, over the past, in past meetings, you voiced concerns about the potential volatility of more aggressive investments. So in general, if we were to go the 115 route, and assuming it were socially conscious, it seems like you, in general, I'm assuming you would support something that was perhaps a lower return, but a less volatile investment strategy.
Yes, yes, indeed. You're right.
Okay. And to be clear, I think that a risk that would face the library has less to do with, well, certainly if there was volatility or an unexpected drop in our revenue, that would be serious. But if we had a year or two of poorer than expected investment returns, the payments we would have to make to CalPERS to start to close that gap would increase. And that's one of the reasons why a 115 trust can offer some additional stability. That's something we have no control over. So even if our regular revenues were good, if there were a couple of bad years, we would have to be closing a more significant gap. Am I right in saying that, Myrna?
That's correct. And I'll just throw this in there is that, you know, we did have Bartels do an analysis of our pension costs. And I could share that with you all again, but it did do analysis of historical markets and where we could find some gaps between what our normal cost, what our expected cost according to the schedule that we saw today in the baseline, and what are some possibilities of having spikes in the future. So I could share that with you all. It is complex. It is a very complex topic. So I appreciate that. In terms of the comment regarding our stable revenue, we do have stable revenue. And we also have a healthy fund balance. And the fund balance right now of $15 million, and knowing that we have these costs that are, you know, required, the normal costs and our minimum payment, we know we have to make them. There's no option. They're not optional. What is optional is making additional payments or just even managing our funds, our assets. So right now, our fund balance of $15 million is pooled with the Treasury. And although it is very, very safe, it is last quarter, we made 1.5% interest on that. And if we know that we're going to have to pay our minimum payment and our normal costs sometime in the future, and we could set aside a couple $1 million, we will be earning with CalPERS at least 3.5% interest.
Got it. Thank you for sharing that. Barbara, again, looking just for an initial high-level reaction and what you think we should do next.
I was going to say what Myrna just said, which is we have a very healthy unrestricted fund balance. And this is a great place to put a good chunk of it. We have to pay it. It's a debt that we have or an obligation that we owe. So I'm all for that. I was persuaded by the presentation about the hybrid approach, which I thought was a good one. And I thought it was interesting the healthy healthy amount is either having, being 80 or 90% funded, which is one way to look at it. And then Kurt's thing about you really want to get to 100%. So I kind of, we have to get there, and I'm for going there for sure. And again, rely on Myrna and her advice. But I would support I would support a hybrid approach and doing, making a major significant investment and paying this down.
Okay, thank you. Do you have, to Dave's point, if we were to set up a 115 trust, do you have feelings one way or the other about CalPERS and about the fact that they're not divested from certain types of businesses?
Well, I share the same social concerns. I just recently read an article actually, though, about what a tiny slice of the massive CalPERS investment portfolio is invested in the kinds of things that, socially we don't like. So I don't know how hard it is to find somebody else to be the trustee. I don't know what their other choices are and stuff. I mean, I feel like it's I would go with CalPERS, unless there's some, really obvious, simple, alternative to that.
Okay, thank you. Deborah, initial reactions, please.
Sure. I share Barbara's reactions. I think we have the money to invest now, and I think that it's a long-term investment that's incredibly important. I also share the hesitation about possibly investing in companies that are not socially aware or at least on the list, and would at least try to at least see what the alternative is with CalPERS. My one question, and this is for probably a later date, if Measure Y is not renewed, if our tax measure is not renewed, what happens? And,
Doom.
well, no, but I mean, I'm sure that Myrna has taken a look at some of the numbers. I think it's may not be appropriate to do that now, but so we can take care of a couple of very hefty years, and if we have a lower number of staff, and if we have a lower amount of pension to pay off if the measure doesn't pass, then we get to that bridge when we get there. So, but it's something I think that all of us are probably aware that that's a big thing.
I agree, and I'm going to go out on a limb and say that it's something that I think all of us recognize has to be a priority for our time and effort over the next 18, 19 months. Thank you. And Myrna, thanks again for arranging all this and for doing all the work here. I think obviously we're not making any decision. I think I will follow up with you offline about some possible next steps, if I may.
Yes, sure. I'm happy to continue this discussion. I hope that it was very helpful.
And just a final note, I think the commission, while they haven't been wrapped up with this as we have certainly had prior conversations about this. And so I think that with a little bit of hand holding, I think that it's easy enough to follow along, and the charts are pretty clear and the numbers are pretty clear. So I think we can have confidence in our colleagues.
Okay, I'm glad to hear that, and I'm hoping so too. And I'll just commit to, when we decide to make that presentation, I'll work closely with Myrna to make sure that we present the clearest possible case. Yes, Barbara.
But and to remember that, fortunately, this is on Zoom, so we can refer our fellow commissioners to this, watching this meeting, which has a lot of the detail and the questions in it. So.
Great point. Thank you. Listen, I know we've already gone over. We do have a little bit more to cover. So I'm going to suggest that we move on to the financial reports. I'm just going to make a couple of introductory comments here. And again, Myrna, thank you for providing the background information and summary, which is super useful. As a reminder to everybody, we're looking at January, so we're 7/12 of the year. For expenses that are on a straight line basis, we would want to see them at or below 58% of total budgeted amount. Our sales tax revenues lagging 2 months behind. We only have 5 months of sales tax revenue. We would hopefully like to see those at or above 41.7%. And I think the big picture is that revenue is at or above projections. Expenses overall are below budget, and not a lot of changes from last month. Myrna, I'll let you kind of continue from there if you would, please.
Okay, sure. So the highlights for this are that with our revenues, we're pretty much on target. In terms of Measure Y, our sales tax, a preview, we just received our February receipt, and it came in strong, $1.6 million. And as you can see, compared to January, that is good news. So we're on our way to meeting our target here of $15.5 million. And we'll continue, of course, look at our monthly receipts. On the expenditure side, we did apply a 4% COLA to salaries, so that is reflected here. And we still have a little bit of savings in our salaries and benefits amounting to attrition. Our Measure Y, we did start, in November, so a little bit of savings there as well. So, it's not unusual. And we do expect expenditures to stay within our budget. And again, in terms of our capital projects, I am expecting a lower expenditures, given that major projects were delayed and pushed into next year. So we'll be seeing at least a $1.3 million expenditures under capital. And our cash is in line with our historic cycles. And our fund balance has not changed. And you will see at the commission meeting on Wednesday to approve the budget adjustments to revenue and some to on the expenditure side. So in the following month, you will see some changes to our fund balance given what's in front of the commission on Wednesday. So those are the highlights for the January report.
Thank you, Myrna. And just to clarify, although the written reports that we got included the fund balance statements, at this point, there are no changes from what we've seen previously. It won't be until the budget changes are approved that we will see changes there. Is that correct?
Right.
Yeah.
Correct.
Okay. Good. And I noticed also that there were no expenditures of over $50,000 for the month of January. Any questions from any members of the committee? Seeing none. Oh, Barbara, you're on mute.
When you mentioned that about the over 50,000, surely our PG&E bill is over 50,000. Since it was over 50,000 in December when it's recent called.
Well, I didn't see any.
I didn't see any either, but it's kind of, maybe we haven't paid it yet.
Well, it looks like the PG&E bill was actually 2 months, was 114,000.
Yeah, that was in November when
The
we paid
previous
that.
was 65,000. Yeah, so it could have been a timing thing, and maybe we'll see 2 months next, but there was nothing here.
Sure, I'm not sure where we are with that, but I can send a follow-up email on that.
Okay, thank you, Myrna. Thanks for asking the question, Barbara. Anything else on the financial reports? Okay, Myrna, 4.3, how you doing on the 5-year forecast in your spare time?
That's a good question, Andy. I wanted to give you an update on the 5-year forecast. And, it's all coming, dovetailing with the question about, setting aside and making any additional payments
Right.
with our pension costs. So how much, can the library afford if it were to set up a 115 trust or make additional payments? Those questions will be presented, could be better addressed when we have the 5-year forecast. So I'll share with you, if I can, just a couple of slides to show you what I hope to present to you all.
While you're doing that, Myrna, I see that Julie's on the call, and so I just want to, expand my shout out to you, to Julie and your whole team. We appreciate, I know this has been a super busy time with the regular monthly reports and working with the staff on budget preparation and doing the 5-year plan and training and policies. And we know there's a lot going on behind this. We appreciate
There's so much happening. We have interviews for a new accountant coming up this week, and she's been working so hard on automating our purchasing policies, as well as reconciling the Friends accounts. And she made a presentation to all the branch managers on that with our new procedures for tracking those donations. And branch managers will be speaking with their Friends groups, and we're always available to answer questions. So those are some updates for Julie. Julie, did you want to add anything?
No, thank you, Andy. Thank you, Myrna. I'm just going to keep working hard, and hopefully we'll see some really good effect with this new purchasing procedural launch.
Well, we very much appreciate it, Julie. Even though we can't see you, we're like waving and nodding and applauding. So thank you. Okay, Myrna, so let's see what we have here.
So what do you see?
We saw, until just a second ago, we saw some slides, and now we don't.
Oh, okay. Let's see. I think I have. Okay, there we go. Share.
Yep. Now, okay. Yep.
Okay.
So now we're seeing your next slide also. So I think you want to change the display. Yeah.
There we go.
There we go.
There we go.
Ka-ching.
Okay. So I just would like to reiterate what the couple of goals are for the 5-year forecast, is to understand the 5-year trend with our baseline and baseline revenue and expenditures. So a point in time of what those are. And we're looking at fiscal year 22-23 when it comes to our baseline for salaries and benefits, for example. And the other major goal is to ascertain our revenue growth in order to make informed decisions about the best use of funding, of what to do with our funding, and to strengthen the library operations. So just as a snapshot, here is total revenue matched up with the total expenses. So the yellow are the total expenditures, and the green is our total revenues. And we have a percentage of history. The red line demarcates where the forecast starts. So the forecast starts in fiscal year 23-24. And so as you can see, we do forecast an increase in expenditures given our, salaries and benefits, normally have an increase. And also an increase in revenue given our historic trends. So even with conservative assumptions, we still see increases in revenue. Where I'm trying to ascertain is what is that difference between the forecasted expenditures and our forecasted revenues. What quote unquote surpluses would we have so that the commission can make informed decisions as to what to do with that funding. One caveat is that in this expenditures, it does not include our capital costs. So these are just salaries, benefits, services, and supplies. I will be refining this to include an average cost towards capital and making some assumptions for projects going forward. But as you can see, we normally do spend about 90% of our revenue. The next slide is salaries and benefits. Here, the green is the total, is salaries, is all salaries. And the yellow is our benefits. And the benefits include major costs, which are the OPEB, the OPEB one trust, which is $750,000, and our workers' comp costs. And so this includes everything. So these are not just direct benefits toward our employees, but all our benefit costs. And so they tend to be around, 40, just under 50% of compared to salaries. And as you can see, the salaries are the ones that are increasing more. It has a more increasing trend than our benefits.
So Myrna, can I ask two questions here?
Mm-hmm.
First, I'm looking at fiscal year 18-19.
Mm-hmm.
It's showing benefits as 60% of salaries.
18-19.
Yeah.
It did. You know why? I think that's when you initially made your OPEB.
Oh, so the
initiated
additional
your
OPEB payments. Barbara's nodding. I think that's it. Okay.
Mhm.
Now, my other question is, I understand why we expect salaries to increase, but I'm noticing that benefits basically looks like it's a straight line, does not seem to be showing any increase over the next few years. How is that possible, considering that everything is increasing in cost?
Well, for example, some costs are where we see an increase is in healthcare, and so that's where we see the increase here. The others are pretty much flat, but healthcare is where we see a lot of increases. In terms of our pension costs, we do see spikes, as you saw, but they're not huge, so compared to salaries, we've in this what I can include in terms of our assumptions, we've added a handful of new positions to be funded in future years. And because of the Roseland Library, for example, and also we did build in some assumptions in terms of COLAs. So there is a little bit of an increase there, and our benefits, yeah, as you stated, are relatively flat, but the increases that we do see are are primarily pension and
Yes,
healthcare.
Deborah. Hello?
Deborah, we're hearing your sound.
Yeah.
Erica,
And also the majority of our employees are enrolled in the PEPRA pension, not the classic. So, and over time, as older employees retire, those that may have been in classic, we will reduce those number of employees. So that also will affect our pension costs.
That is true. That's why it's relatively flat, is that at least the numbers that CalPERS has provided to us in terms of our normal costs and our UAL, minimum UAL, that's what is in this assumption, are pretty flat. Because our classic employees that are more expensive are retiring, and the majority of our employees will be PEPRA, and there is a significant cost savings with PEPRA employees.
okay.
And so the next steps are to refine expenditures to include capital and ascertain the 5-year revenue trend and the expected surpluses. Also to add a scenario where Measure Y expires. And with all of this that will be happening in the next couple of weeks, we will be incorporating some key findings for the budget workshop.
Wow. Well, I know you've got your hands full there, and appreciate all the effort that's going into this. Do we have any questions from any members of the committee? Okay, well, thank you for the update. So then as I mentioned at the beginning of our meeting, this is our last meeting in Zoom. And so moving on to item 4.4, the in-person meeting location. I hope there's going to be a big reveal here, because I don't happen to have any information. Is this a discussion about where we should meet, or what? Myrna, do you have a recommendation for us? Should we be meeting at headquarters? Dave, I see you have a hand up. You can offer your living room for us?
Sure, anytime. We obviously don't need a really big space. We need something fairly, I would prefer something fairly centrally located. We could always use something smaller in the Roner Parkatati Library. I would rather not go to RPHQ because I think it's awful. I would object to Healdsburg.
Boy,
sorry, Andy.
So let's see, you're slapping down me and Erica and Myrna at the same time here. Okay, so you're opting for something more. Do we have, are there other committees that have already decided where they're going to be meeting?
No.
Well, the Measure Y committee has decided to meet at the Central Santa Rosa Library.
Is that, would that location be acceptable to this group as a potential meeting site for the next meeting?
Works for me.
I think we have to figure out whether there's actually programming going on.
Yes.
there. Yes.
I can check about that. Yes.
If you could, Lisa, I appreciate it. And let me, I was going to say, Barbara, and I'll let you speak. I'm going to be away the whole month of March, and I reached out to Barbara and asked if she would be kind enough to chair the meeting in March, and she has graciously agreed. So Barbara, in my absence, will be working with Myrna and Lisa to set the agenda, and of course, we'll lead the meeting. Barbara.
I would just make some sort of point about a consistent meeting place, rather than we kind of go here and there. And, you know, so we're really talking about just 3 committee members at the next meeting, right? I mean, And
All
I'm
right.
down here and David's in Santa Rosa and Deborah's in Windsor. And then, but, you know, on an ongoing basis, you know, rather than having just like the next meeting in Santa Rosa, I think we should have maybe a little more thoughtful discussion about, I think in commission meetings, we're talking about maybe the next number of months, like the next 6 months or something like that in Roanoke Park at in the meeting room there. So my preference would be, especially if we, you know, think that the public might be interested in joining us, you know, that we have a kind of a set place.
I think that makes perfect sense, with the exception that having never had a meeting in this proposed space, I mean, it's possible that we might do one and everybody says, gosh, that was awful. You couldn't see the screen. We couldn't hear anything. So assuming that it's going to be okay, I have no problem saying, let's set a meeting for March, and assuming that there are then no serious objections, that we continue with the same location going forward. Would that be okay with you?
Yes, that's fine. I'm just not sure that I would vote for Santa Rosa
What would you recommend?
personally. Well, obviously, I've gotten spoiled. I mean, we've got the Roanoke Park Library and headquarters both down here. I don't have the same objections that David does in terms of headquarters. They have, you know, very good, you know, media, audio visuals and so forth there. I don't know, are we going to be recording our committee meetings? And, you know, we didn't used to. So, I mean, that's kind of one of our considerations. The fishbowl that we've talked about, we don't want to have our commission meetings in there, but a smaller group of people might be more acceptable.
I tend to agree, Dave, with Barbara, and I realize you're not crazy about headquarters, but that is where our staff works, and it would be a benefit to them if we don't require travel time for them to go to another location. I would be inclined to try to have the meeting at headquarters, and again, if there's strong objections afterwards, to reconsider it. But I'm assuming that, Myrna, that would be better for you than if we chose some other location. Is that right?
Yeah, that would be very convenient for me. But I'd go wherever, you know, the committee would like.
Okay, Erica?
It's a big district. It's a big county.
I mean, I think that, you know, it's not so much for us to travel. You know, we have laptops, we can bring them with us. I really thank you for considering our needs, but I think that, you know, we could easily do it at Central or HQ or Roanoke Park. You know, it really just depends upon what's going on at Central Library and whether or not the room is available. We also have to think of our IT staff as well. And I guess Lisa is do you know the answer to the question about recording? Because that will change the equation a little bit.
Yes, I heard there are recording capabilities at Central. But we're also investigating whether it's, you know, required by that the committee meetings be recorded or not. So we're working with legal counsel to help us answer that question.
And do you have recording capabilities at headquarters?
Yes.
Okay, in that case, I'm going to ask that we, and I realize I'm not going to be there, but I'm going to ask that we have the March meeting at headquarters, assess whether it's acceptable after that experience, and if so, continue for a series of months.
That's fine with me.
Thanks, Dave. I appreciate it.
Not a high profile issue for me.
Thank you. Barbara?
Oh, you know, I don't know if we're going back to the way it used to be, but of course, we used to have a lot more committees or somewhat more committees, and we had all the meetings at headquarters. And there was a certain organization to that you know, was kind of a predictable, you know, way to go. So that was kind of nice. I don't know about the Measure Y committee, why they decided to meet in Central Santa Rosa, but anyway.
I don't either, but in terms of commission committees, I like the idea of meeting at headquarters, and again, although I'm sorry I won't be there in March, I like the idea of being able to meet the staff, especially the folks on the, you know, in the accounting team that we don't normally get to see and who are doing all the work. So let's agree that the March meeting will be held at the headquarters. Any items for future meetings that you'd like to bring up? Hearing none. Thank you all. I know we ran over, but very, very important and complex topic today. And as always, I appreciate your attention to detail and your care and concern for the library. Next meeting will be Monday, March 20th, 3 o'clock at headquarters. Barbara, thanks in advance for leading that. And it's 4:39. We're adjourned.
And we'll see you on Wednesday.
Yeah.
Thanks, Dan.
All right, thank you all.
Look
Bye-bye.
forward to seeing you all in person on Wednesday. Thanks a lot.
Right. Thank you, Andy. Thanks, everybody.
Bye,
Bye-bye.
everyone.